Well, hello everybody. It is December 13th. This is the weekly review where we take a look at what happened, what we think may happen. We've only got a couple weeks left in the year. You got the big Fed meeting this week. And last week, these markets, they basically took a beating. It was down, and more down. 4% here on the NASDAQ, 5% on the Russell. The Dow and the S&P were down the least, primarily as a result of some merger news. On the year, Russell down 7% almost, 3% on the Dow, 2%, and 4% still up on the NASDAQ. Not what you wanted to see, certainly not what I wanted to see last week. I just wanted to see it hang and set up a better move off of the Fed, but now it's going to be a chore, and now we're going to really see how these markets behave when the Fed does whatever the Fed's going to do. If we think about it from a quick review kind of standpoint here, basically what we had last week is we had these huge currency bets going sour off that Draghi news the prior week. If you remember, Draghi came out. We didn't see the sort of response that was expected from them in terms of more QE. They extended the program, but they didn't extend the size of it, and the market sold off. The euro started to rise, as we can see here on the daily chart. On the weekly chart, this thing is still in that bearish retest regenerate zone. That's off this prior swing low. It's right at the top of it still, trying to break higher, and actually just got over it this week. If I pull this in correctly so we can see it, right about there is where it was, and you can see it peeking over the top now. So if this is true, right, and if it holds for another week, and this week, of course, with the Fed, we'll find out if it's going to or not. That's going to say it's more like this instead of like that, and that's kind of a heads up that this currency move by the dollar and the expectation that the dollar is just going to continue to rise is probably misplaced, and all those bets on the other side of this, right, are going to go sour. And if you look at the yen, the yen's doing the same thing. The yen's all the way back up doing the bearish retest regen now off the swing point low here, 80.18. It gets to 80.18. It's right at the critical levels. And so many times that's what you see, right? You see a big news event, a known news event, and markets stretch it right to the point of breakage in front of the event and hang it there. And then the event itself ends up being a big move one way or the other. And I suspect that's probably what we're going to see in these currency markets. Now, the currency markets, they create a lot of disruption. They're so huge. They create disruption in bond markets. They create it in the equity markets. And that's created a lot of angst and fear trades that took place this last week. The world markets were hammered in a steady week-long bout of selling. If I pull up the emerging markets, for example, the emerging markets, the EM, is down here testing the lows now on the daily. And you pull it back on the weekly. This is the lows they're into. You got a big volume low out there. Are they going to go down and test that and try to break it and break even lower? And if we pull over the monthly, you can see what kind of damage has been done out here. This came up into the bearish retest regens off of all these swing point lows it broke, rolled back over now, and is trying to head lower. So, when I look over at the world, right, the world doesn't look so good, right? If we talk about emerging markets, that's where more risk is. A lot of that risk is tied to the dollar. Even though the dollar has been pulling back, these markets haven't been able to find a bottom yet. As part of that, right, you're seeing the Treasury show life. And the reason for that, of course, is the fear trades as well. Treasury's coming up still. They haven't been able to get a higher high. They haven't been able to break swing point highs yet. But it's coming back up here to test it again. And if it's able to break it, right, then that could signal that the fear trade is really on in a big way. But right now, money coming into it, telling us the fear trade's there, but so far It's not saying that we have a huge problem on our hands, just some angst at this particular point in time. The real fear, if you're looking for fear, is in the junk bonds and the high yield bonds. As they plummeted on that mutual fund liquidations, Third Avenue, that sent some shock waves through the market. If you think about the way those funds are set up, the ideal is that you can pull your money out of those funds anytime you want. They're ETFs basically, right? And for those funds to see, Third Avenue to come out and say, hey, we're not going to let you redeem your monies on an as desired basis because they don't have the cash on hand to do it, really sent some shockwaves, because that's an assumption that's out there, and now that assumption's been broken, and that creates fear, right? When something that's basic goes awry. Now, in this particular case, that particular company, and what they're dealing in is really the junk of the junk bonds. And when we look at junk bonds, you can see how much they've been hit. Of course, they've been hit primarily off the continued plummet in commodity prices, in particular in oil companies, and the debt that they've issued. And these things just fell off the cliff. Big volume spikes. If we pull it up on a weekly, you can see the volume escalation, right? These things have been hit. They've been hit hard. They're breaking the lows from a year ago. It's a year-on-year loss. That's the first time that's happened since 2008 and 9. And so there's a real concern here that this part of the market is breaking down. And that's where the real fear came from this week. That's why we saw the continued selling on Thursday and Friday in particular. And we have to realize that the particular company, right, that's in question is dealing in the lowest value junk that's out there. And, the question is are they just the tip of the iceberg and everybody else is going to follow, or are they an aberration and they just weren't positioned correctly? Well, people don't always know, and what they do is they sell everybody just in case. And so these plunges and volume spikes that you see in all these junk instruments, right, is causing what we saw in terms of the fear trade that started this week. OPEC inaction last week, that led to a total collapse on the West Texas Intermediate. And if we looked at the ETF in that area, let me pull up OIL, we can see that continued plunge here, and you can see it on the weekly underneath the swing point lows. Now it breaks, and on the monthly it just continues down. So the one thing I would note here is that these are getting close to an ABCD structure on the way down, and so there's not as much to go. Well, at least on the weekly, that's the case. So, are they going to continue in a large way to the downside? No, they're probably getting close now. But at the same time, it's just more of what's driving this fear trade as OPEC does nothing, as oil is totally and inventory is totally oversupplied now, and nobody seems to see an end to it. I believe all of this is transitory, in my opinion. I don't think it's going to lead to something larger, but that is what drove price this week. Many of the world markets, technically, if you look at these, they're coming back into their lows. We just looked at the EEM, and of course many of these are tied to commodities. This is Australia, for example, coming down to test a swing point low. It's doing just about as much or more volume. If you look at it on a weekly, there's a high volume low out there, and you're going to see that on most of these is coming back to try and test it, right? And so the August lows, the plummet in August, these countries, that are on the weaker side, the emerging markets in particular, here's India, they're coming back to test those high volume lows in most cases, and they're going to try and break them. Whether they do or not is a different question, but that is kind of the scenario that's going on in all of these. The German and the French markets, and I'll just pull up the German market. they're finishing off ABCD structures to the downside, and they're almost done. The German market, for example, is about 100 points to go at this particular point, and it's trying to get into the bottom of this bar. That also was a retest regen off of prior swing point high over here, and it's way more than 6 bars on this breakout. So my expectation is they will buy it. And so those markets are nearing, kind of a completion. And finally, if we turn to our markets, our markets are coming back into the highs of the lows back from August. They're not there yet, but they're starting to. So here's the daily. I'm on the S&P trend transition, right? It breaks down. Here's the highs of the lows. On this particular chart, it's 1993. That also is a high volume low from back here in December last year, when we also had the Fed meeting. And actually, I think that was that week was also options expiration, just like this week. And so this area is a critical area as it comes back into it. And we can see, we definitely can probably see this thing come back into this price point, right? And test into this area. There's nothing to stop it now as it's broken this swing point low. So our market's also getting riled by everything that's going on around the world. And again, everything depending now on what the Fed does come Wednesday this week. Now it's not all horrible. If we come back to the S&P, we just finished, for example, if we're looking at the details of what's going on, we just finished a little ABCD structure already, right? It's already under it and it's already extended past it. So, for example, in that case, you've already got that. Many times you'll get a bounce right after this sort of action. And I think the main thing that we need to consider is that structure for some sort of a larger decline is not apparent here. I mean, surely, it can happen. We can continue down. But the structure to get a real plunge just isn't in the cards yet. It doesn't show up on the charts. And in a little bit here, we'll look at that in more detail. But that's a main takeaway here. On the negative side, right, I've already touched on a bunch of this already. The junk bonds, the oil markets, the treasury bonds, the dangers of these world markets potentially breaking down. I think on a bigger picture, though, if we look at some of this, if we go in here and we look at the weeklies on the NDX, for example, we got over these highs from, it was prior to August, right? We got over these highs. And then we actually, as we got over them, we were unable to hold them. And more importantly, we didn't see, right, follow through elsewhere. So if I look at like the S&P 500, which was even more weak, right? The S&P 500 on a weekly chart was unable to even get over the breakdown bar, right? This was the key bar we were watching. It tested it twice, here and here, unable to get over it, and then just like we saw before, gives it all up. Now, the last time we did this, we reversed and did a takeaway bar, hung up there 2 weeks again, trying to break out, and then finally give it up again. Now, are we going to get another takeaway bar? I have no idea, right? Fed's here. You've got to buy the news kind of situation setting up. But so far, the key thing that needed to happen still hasn't happened. And if we look at the NASDAQ, the composite, you have the same case there, right? The composite comes up. Now, it's a little better off in that it got over the takeaway bar, suggesting it's going to try to test and break those highs. So it gets over it, 3 times, but it never gets to the highs and never tests the highs up here, and now comes back down. So the good news is that they're trying. The bad news is they haven't been able to. And the really bad news, of course, is in the Russell and the small caps, which have lagged all year long. Small caps break 3 swing point lows this week. That says we're probably going to get some follow through to begin the week. That follow through is going to try to take us into this high of the low, right, and potentially deeper. And if we bring this back to a monthly, if there's a danger spot, it's here on the Russell. It's this October of last year, 1040 is the number. I mean, if you get down and you break that, that's going to be a trend transition on the long-term time frame, and that's a big deal. And if we look at this closely, right, there is the potential here on the one index, which is the weakest one, to do an ABCD structure and to break it. And so if I had to worry about something, it's just what I continue to see here in the Russell. And that is that the Russell still can't lift. And even though we looked inside the Russell once, I think it was 3 or 4 weeks ago to see what was moving it, and it's not the oil stocks. What's moving the Russell seems to be more of the financials than the oils. A lot of the financials continue to get hit as a result of the oils, and so the continued plummeting in the oils is affecting the Russell in a broader way as a result of that, but not as a result of that being what's in the Russell itself. So this is where the worry spot is. This is something we have to continue to monitor. We're still a little ways away if we're going to get the bigger break, but it's developing that way, at least given the way this past week went. We're still at a point where we can go either way. This still could be the big topping process, but then again, this could be nothing more than another continuation pattern that eventually tries to resolve higher. It won't take much more to roll the short-term sectors back to bearish trends. That's another thing that we need to watch. As a heads up, in the weakest Russell, right, it's already back to bearish on the short-term trend, but we just got sideways breaks or trend transitions that took us to sideways in many of these sectors, and there's not much room between here and the next swing point low to actually turn these bearish again. And if I want to walk back over here, most of these are still bearish. This market, the danger comes around the beginning of the year. Beginning of the year, first couple of weeks of January, if these cannot go to bullish and start pulling these higher, then we're going to see some problems begin to develop. And so that, to me, is where the bigger risk lies. It's a few weeks out. We're not heading the right direction right now, and it needs to turn on this Fed, or we're going to see continued deterioration here, which eventually can bring this down, which itself can eventually take these down with it. And that, when it changes, means we have a bigger problem than what we do now. So if we consider the fundamentals, it's all about the Fed this week. Bank of Japan is the day after. If we think about the negatives, right, it's the currency, it's the machinations that are taking place there. The lack of liquidity in general is a problem. And, if you remember back in August when we had that big spike down on the Monday, that spike down to some degree was a result of the liquidity just drying up and on a very short-term time frame. And let me bring up the charts. If you remember, I did an article back then, after it took place, and actually that morning in the trading room, I was talking about, buying these spikes down. Here was the Apple plunge off the open, 10% down off the open. Starbucks, if you remember, opened down about 10 and then went down about another 10. Eventually, all recovered that same day. The ETFs in particular really got hammered off the bat. These things are not as liquid as they look. And yeah, they're doing a lot of volume, but a lot of the volume is created by the programs. And when the programs sense issues, right, they have shut-off mechanisms. They quit buying. When they quit buying, prices plunge. And so there's this type of liquidity event, right, that can take us large percentages down in a very fast, unorderly way. And to me, if we're looking for risk, that's the biggest risk out there, is that you see these kinds of plunges take place, because the programs just back off and quit buying for a short period of time until the market settles. And then, of course, they swoop back in and start buying again. The other problem, of course, is that these ETFs, in particular, like the junk bonds, some of these are illiquid. In other words, what they're dealing with is illiquid assets. Junk bonds, those are usually, at least in prior life, right before these ETFs were created, they were a result of, bank to bank, or, you're dealing with banks mostly to do the placement of debt. Debt itself was mostly in the arena, and still is in the arena of working with banks to buy and sell these instruments. It's not, in large institutions, it's not, there's not a quote unquote market for them like you see in stocks. And so these ETFs seek to mirror that in a different structure, one that you can come in and out of. In this particular case, Third Avenue, what they're dealing with is the very low end of that, and they don't have nearly the liquidity, and they evidently did not put enough cash aside to meet withdrawal demands, and got themselves in a pickle as a result of it. And that's why they're doing what they're doing. Of course, that's creating problems for everybody and concern for everybody. Debt structures, they're a general issue. They continue to be. This, in the end, is what's going to bring this market much lower at some point, because you can't service the debt, especially if the dollar really does take off. If you look at the money flows last week, it was horrible. 7% down on the XLE, 2% down, or 1.5% on the safest material out there. So just everything got beat up. And if you look over here at the miners, minor sectors, you had 2% losses on the medical devices, which was the best case. As much as 13% loss in a week in coal. The fracking was 10%. The regional banking, which we got stopped out of, was 8% on the week. Just huge pushes to the downside. A lot of this financials, a lot of this energy. What do you expect? Well, last week I was not even close on either of the calls. I was looking for rotation back in the small caps and for the breakdown bar to be gotten over. Neither one happened, and they weren't even close. It was just selling all week long. This week is, do we see a buy the news event off the Fed? I think that's the primary risk in terms of which way this market goes. We could see a big bounce as a result of that. And this junk bond liquidity fear, is that going to subside, or are we going to get some sort of a fast drop and a quick recovery, just like I was looking at here on these charts with like the XLF and so forth? Are we going to get one of these plunges again? Economics, it's the Fed, the Bank of Japan. There's plenty of other data, but I don't think it's really going to matter. What's the bottom line? Well, to me, that bottom line is do we get some sort of a death by 1,000 cuts type action continue? In other words, we keep hanging and slowly deteriorating inside the market structure, or do we go make new highs? And so, if I look at what happened this last week, it kind of fits in with this death by 1,000 cuts type scenario, where we keep pushing up to these highs, yet we're not able to take them out. And that's most evident here on the weekly charts. And if that's the case, if we really have distribution taking place up here, and it could be, then eventually you're going to get a breakdown, a deterioration, and a total collapse kind of, after a long period of distribution. So I wouldn't say total collapse, but a large push down after a long period of distribution. So, that's the fear on a longer term basis. If you try to measure where things are important, these to me are kind of the key price areas that we have to be focused on. And so if I pull up that S&P again, on the weekly chart here, you can see this high volume lows high. Price point on it is 1993. That year ago low was 1972. And so if I come in here and say what's critical, it's that 1972 area. And you can go through these other charts. They have the same sort of structure. The Russell's a little bit different, but I've laid out the price points for you. I'm not concerned or as concerned unless these start to fall. Then it's at that point that the structure is in place for something much larger to take place to the downside. And so that would be much more problematic. Right now, it's as it has been. It's up, it's down, it's all around, and it has no momentum to the upside to take us higher. Last week, I've been positioned long. We took some hard hits this last week on the portfolio, the KRE, the IWM. They got stopped out. I added to Sky, and if I'm looking forward, I'm looking at Microsoft as a potential add just because of the strength in that issue and the way the charts are set up. I actually had a question about it as well, which is interesting that one of the members was looking at it too. So we'll take a look at here in a second. I've laid out detailed notes here. There's not much to say other than as things come back, right, that's where we still want to add unless this market starts to totally break down. And so I've laid those ideas out here as always with some detailed notes for you to look at. As far as Microsoft has a strong push up here off of earnings. Continuation, and now it's falling back into this area. At the top here is 54.32. The top of this one's 54.07. That's where it ended up, 54.06. It's had a big run, right? If you look at this on a weekly basis, you can see the big run up, a little pullback right here. If we're looking at this from an ABC perspective, you've got basically the ABCD structure from here on up. That should take it up to about 65 if in fact this thing does fly higher on the ABCD structure. If we think about where good entry points on this, the ideal spots on the way back, of course, is this lower band back into here. And if we move it over on the monthly chart, you can see this monthly high and low both would be places on a retest, regenerate on a long-term time frame if it comes back that far. So the ideal spot is this top or into that bar, then down into this area, and that would be the ideal places to be looking at Microsoft. And so that's what I'll be doing as we get started this next week. Thanks for joining me. Have a great one, and until next time, take care.